Welcome to Satya Skills. In this video, I would like to introduce you all some basic concepts about insurance. Fast changing modern economy, highly competitive markets, changing technology, etc. involve several risks. Risk became common factor to individuals and institutions, but every risk results into a loss. Usually, the economic necessity of protecting individuals and institutions from loss of risk gave birth to the concept of insurance. It is to provide security against risk insurance came into existence. Today, insurance is one of the largest financial services in the world that provides assurance of protection to the loss that results from the risk which is insured with any insurance company. Let us see what is its meaning. The term insurance originated from the word insure, which means assurance of compensation against loss. Insurance is protection against loss of insured risk. It can be like this. It is a contract between the insurer and the beneficiary in which insurer agrees to indemnify the insured, that is a client, against the loss accrue on happening of some event. It can be defined like this. Insurance is a contract between two parties whereby one party called the insurer agrees to pay to the other party called the client or insured a certain sum of money on happening of a specified contingency or agrees to indemnify the insured from losses arising from specified events. There are certain basic principles of insurance which is very essential for all exams. First one is insurance is a contract that everybody should understand. Insurance is a contract between insurer and the insured, that is client. Contract of insurance is a general contract. Therefore, it is governed by the principles of law of contract. In this contract, offer is proposal from the insured and acceptance is the issue of the policy. Consideration is payment of money against the loss specified in the policy by the insurer. For this purpose, insured will pay a specified amount of premium to the insurer, that is insurance company. Second one, insurance is against specified risk. The concept of insurance originated from the idea of giving protection to loss arising from any risk. Therefore, risk is the base on which the concept of insurance is built. A large variety of risks are under the cover of insurance. They contribute to the fund in the form of policy, and out of this pooled fund, the company pays compensation. Now, let us understand insurance means a cooperative mechanism of spreading the loss of risk over a large group of persons. Then utmost good faith. Insurance is a contract between insurer and the insured. In this contract, the insured knows more about the subject matter of the contract than the insuring company or the insurer or the insurance company. To make the contract valid and effective, the insured, that is the client, should disclose facts about every aspect of the subject matter of insurance contract. Insurer can estimate risk and decide premium on the basis of information given by the client. Therefore, insured should give all the required information. Concealing of truth or any fact that affects the subject matter of insurance contract makes the contract invalid. Then, it is a contract of indemnity. Insurance is a contract of indemnity, and indemnity means in case of loss, the insured shall be paid the actual amount of loss not exceeding the amount of the policy. Contract of indemnity is applied in case of marine insurance, fire insurance, etc. The underlying principle of indemnity is that the insured is not supposed to make profit out of loss insured against. If the insured is allowed to make profit, he may purposefully cause damage contract of life insurance is not a contract of indemnity because insurer is liable to pay the amount mentioned in the policy upon happening of a contingency or after a specified period. Thus, it is contract of contingency. Understand? Life insurance is contract of contingency, whereas fire or marine insurance etc. are contract of indemnity. Then insurable interest. Insurable interest is an important component of insurance. It means that the insured need to have recognized connection with the subject matter of the insurance. This makes the direct monetary loss on happening of an event insured to the insured, that is to the client. Example, in a fire accident, if a house causes loss, then the person who would suffer direct loss of property has insurable interest. In the same way, if a person has a pecuniary interest in other person, pecuniary means it is like financial or etc. interest on other person, he can insure the other person's life. In life insurance, insurable interest must be present at the time of insurance. This you please try to understand clearly. In case of life insurance, at the time of insurance. In case of fire accident, the insurable interest should be present at the time of insurance and happening of loss. For marine insurance, it should be present at the time of loss. Insurable interest supports the contract and makes it valid. Then causa proxima. The contract of insurance is about a loss which may happen if an event take place in future. Thus, the event may or may not happen. As it deals with a future event, the contract should be formed on a very clear terms. Therefore, the policy gives a brief and clear description of the risk covered and risk not covered by the policy. The insured can recover loss only if it is proximately caused by the risk insured against. This is called principle of causa proxima. A proximate cause of loss will be considered to pay compensation, but not a remote cause. In this context, proximate implies the cause which is truly responsible for the loss. Then risk must attach. Contract of insurance can be enforced only if risk is attached. The insurer receives the premium in a contract of insurance for running a certain risk which is mentioned there. If a policy may be by mistake or by negligence of parties do not have any risk, the consideration for which premium was given fails. In such event, insurer must return of course premium. Then insured should take proper care. This is an important principle which reminds insured his responsibility in the event of mishap. This is called mitigation of loss. In the event of accident, the insured must take all necessary steps to protect the asset or the wealth from further loss. He should try to minimize the loss as if he did not insure the property. He should take all reasonable steps as if he is the owner of the property and he uninsured it. If it is proved that he failed to take necessary steps to prevent further damage, insurer can avoid the payment of insurance loss. Next, principle of contribution. Sometimes the same property may be insured with more than one insurer. Under such conditions, this principle will be applicable. Principle of contribution means distribution of the risk amount payable to the insured among some organizations. In case of loss, any one insurer may pay the insured amount to the loss to the client. After paying this amount, the insurer is entitled to get contribution from his co-insurers in proportion of the amount insured. But the following should fulfill for this purpose. The same property is insured under different policies. The policies cover the same risk which caused loss. All the policies are in force at the time of loss. One of the insurer pays the loss more than his share. Therefore, he can collect proportionately from other insurers. Then subrogation. subrogation is another important principle which applies to fire and marine insurance. I will make another video on types of insurance, then it will be very clear to you. The principle implies that after making the payment to the insured on the event of loss, he is entitled to be in the place of insured. When the insured receives full indemnity in respect of the loss, the insurer, that is insuring company, will be entitled to every right of insured. If at any time the insured recovers more than the full indemnity, the insurer is entitled to recover it from the insured. The insurer is subrogated to only the rights and remedies available to the assured in respect of subject matter to which contract of insurance relates. Then period of insurance, general insurance or fire insurance are for certain period, usually a year. The contract comes to an end after the expiry of the period. A contract of marine insurance may be for a particular period or for a particular voyage. A contract of life insurance is a continuing contract with a condition that the premium is to be paid at regular intervals. If premium is not paid, the contract lapses. That's all in this video.